presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Asset Management YouTube update for January 31st, 2023. I'm Mo Ansari, President of Compak Asset Management, and thank you for joining me today. Let's take a look at what we need to talk a little bit about the markets, the economy, technical analysis, and the week ahead. Let's talk a little bit about the markets. When we've seen declines in markets, usually the markets have had good years following, except in 73 when the market was down. Following year, still down 30%. Since then, we've had 3 episodes and where the markets have been down quite a bit, inflationary cycles. But the rebounds have been jagged. They have been up and down where the market takes off, comes back down, then takes off again. So volatility is still there. Bond market, when the market is negative, usually the following year is a good year for the bond market. And it's only been 3 times that we've seen negative returns in a long time in the bond market, but the following years have been good. So we will see exactly how it turns out. And the bond market so far is doing very well. Looking at the market performance following Fed hikes, the increase in Fed fund rates within 1 year, we saw a 6% increase in 1980, and the following year the market was down 3%. 84 to 225, up 25%. 1988 increase 20. So when you add it all up, just about most of the years have been positive when they've raised interest rates. And you can see that they raised 4.25%. That is the second largest. I mean, 1980 was the last time they raised interest rates this quickly. We'll see if the Fed stops raising rates this year, which is expected, that they might raise rates tomorrow and then they will stop in March, raise again. Talking to S&P Global and CFR Research, Sam Stovall, he thinks tomorrow is the last interest rate increase. If that is the case, that'll be a surprise to the market, and the market could pop sharply higher. But that is not the expectation right now. A lot will depend on the data coming out, how much inflation slows down, how much the economy slows down, how much unemployment goes up. Right now, economy is not slowed. It's doing pretty well. We've got the GDP numbers. They were up 2.9% for the GDP last quarter. We saw unemployment still holding at 50-year low, and inflation continuing to go down. So there's some positives, some negatives, but we need the economy to slow down a lot more if we expect the Fed to stop raising rates or even start talking about cutting rates. Right now, tomorrow, I believe there'll still be a lot more hawkish talk, tough talk from the Fed that we are going to continue to raise rates, and that could create some volatility. Looking at the economy, disposable income reached the high right here because we were not spending during COVID. Then we started spending again. It hit the same level that was in 2019, or about the same level, but now the disposable income is starting to go back up a little bit. Personal savings, again, took off in 2019. The savings rate went up dramatically, but you can see now, not only are we below where we were, the savings rate, but quite a bit lower than where we were in 2019. So we're spending a lot more, and a lot more has gone on credit cards. As long as people have jobs, they're saying, look, we'll continue to spend. Don't forget to join me on the daily edition of Market Wrap, 1-hour broadcast that I do every day. You can just go and type this in, Market Wrap with Mo Ansari, on the Apple Store, and you will get the app absolutely free, and the broadcast will be downloaded every day. Looking at the technicals, interest rates continue to move lower, which is a good sign for the market. This is the 20-day moving average at about 3.34, so right around there. And as long as we stay above it, we're okay. Today, the rate's at 3.52. So the market is stuck between the 50-day, which is about 3.6 to 3.34, and each one of these lines is what we're seeing. We decided this is where we failed in the 200-day moving average, and market came down sharply, went up again, tested the 200-day, failed a little bit, but I said this could be temporary. Now we're solidly above the 200-day moving average, which as of today is 39.54, right about here, and we closed at 40.76 is the close today. So we're getting close to this 4100 double top. If we can break above that, then the next resistance is 4,200, and there's this tiny gap here between 4,200. So if we can get above 4,100, that would be a good sign, and then heading towards 4,200, we can fill this gap 4,200 to 4,218, and then I think we could even go and test the lows that we set last March. Looking at the weekly charts, stuck between the 20-week moving average and the 50-week. We're finally above the 50-week moving average, heading towards right here, 4209. That would be a very bullish signal. Nasdaq, for the first time in a long time, we saw it get above the 200-day moving average last week. Then it came back down yesterday. Today it came right back up. Resistance now is right around here, which is around 11,500. We closed at 584 today, nearly 11.6. And then I'd like to look at the weekly chart for the Nasdaq. As you know, I showed this dot plot. These dots, as long as they're below the market, all these dots, and this is the market, it's above these dots, it's a bullish market. Beginning of this year, the market went below these dots. Market is here, and the dots are here, and that was a negative indication. We turned up for 3-4 weeks, then turned down again. Guess what? This week, the dots are down here. They're down to 10,088. Market is 11,584. So my dot plot has turned back up. That is a bullish sign. Usually it turns up, stays up for a long period of time. Hopefully we can do that. And like it did, it turned up in April of 2020, stayed positive all the way up till the beginning of last year, 2022. It got at 2020, April, and stayed up all the way through. So we have now turned up. Hopefully we can stay up for a year and a half, get a bullish market. Crude oil sort of stuck between the hope that, okay, we're going to get more demand from China, to worries about supply going up, hope that, okay, we'll have curtailment from Russian supplies, but Russian supplies have been picking up. As a matter of fact, Russian exports are picking up even with the oil embargoes and all of that. And then the oil distillate embargoes go into effect where Europe is not going to buy diesel from Russia, which could take off some demand. So there's a lot of moving parts there in the oil market, and that's why we're sort of stuck between 84 and about $70 and just going back and forth, up and down in this area. Gold market had a really tremendous run since November when it hit 1618. We had nearly a 300-point dollar run. We came back down a little bit here. I think today was a great day, but it looks more like a hanging man on the candlestick charts where there's a long line. And then I think 1884 is a good number, or 1900, somewhere around there to 1880 is what I would be looking at. If we can get a pullback here, it would be wave 4. This is wave 1 right here, wave 2, wave 3, wave 4 pullback, and then wave 5 back to the upside. So I think it'll take some time for gold. Interest rates will go up this week. That'll put some pressure. We'll get hawkish talk from Chair Powell. That could give the market some pause as far as the gold market is concerned. That's the way I'm looking at the markets, but now most of our indicators are turning positive. You've got to start putting cash back into the market that you took off at the beginning of the year. That's what you might want to look at and go from there. I will be in Scottsdale next week. If you want to come to our live seminar, you can go to compak.com. You can register at compak.com. That's all you have to do. And seminars, it is free, and that's when I will be in Scottsdale. Then on the 22nd of February, I will be in San Jose. If you want to come and attend, just go to compak.com, and we will be more than happy to have a lunch or dinner, and you can ask all the questions, anything you want to know about the markets. I will be more than happy to answer them for you. Those are my views. Those are my thoughts as of January 31st. Thank you for joining me today.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.